So, imagine Bitcoin is like the suspension system on a high-performance car, right?
Right.
It handles the regular daily bumps of institutional trading just fine. But overnight, the market hit this massive geopolitical pothole that completely blew out the shocks. Welcome to today's deep dive.
Yeah, it is a pretty brutal reminder of how quickly structural support can just vanish when global panic takes the wheel.
Exactly. We're looking at the market flow data today to map out why that pothole caused such a violent intraday reversal. I mean, we watched Bitcoin drop from over $64,200 down to around $61,600.
It was a really steep drop.
So our mission today is to decode this tug of war between steady domestic institutional demand and the volatile on-again, off-again conflict in the Strait of Hormuz. It's a story we see flare up over and over again.
It really is a perfect case study, in how sensitive digital asset structures remain to sudden macro shocks, even with all the recent institutional integration we've seen.
But let's unpack the timeline. Yesterday, U.S. trading hours actually looked pretty strong.
They did, yeah.
But as the global trading apparatus transitioned into the Asian and European sessions, a 4.1% drop just wiped out all the U.S. session gains in a blink. And the trigger is this Hormuz story, which, I mean, it feels like Groundhog Day at this point.
Yeah, it really does. So the overnight catalyst was the total collapse of the tentative U.S.-Iran ceasefire. It began with Iranian forces attacking commercial tankers transiting the strait.
Oh, wow.
Yeah, and Inticom responded with retaliatory strikes against dozens of Iranian military installations, which then prompted Iran to hit back at American-utilized facilities in Kuwait and Bahrain.
Right, and ultimately, President Trump formally ended the interim ceasefire.
Exactly.
And because this news hit during the thinner, less liquid overnight markets, the automated trading systems just panicked. Algorithms widened their spreads.
Right, meaning they demanded a much bigger gap between buying and selling prices just to protect themselves.
Yeah, and that instant drop in liquidity allowed spot sellers to aggressively push the price down.
The lack of buyers stepping in during those hours, it just acts as a massive accelerant.
Here's where I have to push back a bit, though. We constantly hear the narrative that Bitcoin is like digital gold, right? The ultimate resilient asset.
Sure, yeah, you hear that a lot.
So why does it trade like a fragile tech stock the second actual global conflict breaks out? Shouldn't a hedge move in the opposite direction?
Well, the mechanism driving the sell-off isn't necessarily a reaction to the military conflict itself. It is a reaction to the oil shock.
Oh, okay.
Because the Strait of Hormuz is this massive maritime choke point handling, like a fifth of all globally traded oil.
Right, and when that choke point is threatened, oil prices spike instantly, with Brent crude and WTI jumping over 5%.
Exactly. And to the broader market, a sudden oil spike means an immediate inflationary shock.
And when inflation threatens to surge, global markets just initiate a broad risk-off rotation.
Yeah, capital flees anything deemed volatile, what traders call high beta assets, which completely overrides the safe haven narrative because investors suddenly just need cash.
We saw that play out in real time, but the response to this whiplash isn't uniform across the board, is it?
No, definitely not.
Because on the other side of this overnight panic, you have the institutional money, which operates 24/7.
Right, and it's a very fractured institutional landscape right now.
Yeah.
You have discretionary capital, like the active traders, who are absolutely de-risking.
Like how spot ETFs from Fidelity and ARK saw multi-million-dollar outflows as those investors hedged against all the uncertainty.
Exactly. But passive, rules-based equity investing is completely ignoring the noise.
Like SpaceX formally entering the NASDAQ 100 index, they hold almost 19,000 Bitcoin on their corporate balance sheet.
Yeah, and because passive index funds are legally required to buy component stocks in exact proportion to their index weight, this rebalancing forces billions of dollars into SpaceX stock.
Creating this permanent liquidity sink.
Exactly. It's a structural bedrock that quietly removes supply from the open market, totally oblivious to whatever's happening in the Strait of Hormuz.
Which means anyone buying a standard retirement fund just accidentally made their grandmother an indirect Bitcoin investor, probably without her having a clue.
Pretty much, yeah. The macro environment will keep throwing potholes at the market, but the foundation absorbing those shocks is getting much heavier.
So what does this all mean for you listening? Bitcoin clearly remains hypersensitive to these recurring macro shocks.
For sure.
When oil choke points get threatened, the market still flinches. Yet underneath that surface-level panic, structural financial integration is just quietly, methodically advancing.
It leaves a fascinating question to ponder.
It really does. If passive, automated funds are blindly sweeping up all the available supply into corporate treasuries, what happens to the retail users who actually want to use Bitcoin as a decentralized currency? Are we inadvertently locking up the world's most accessible money inside centralized corporate vaults?